Welcome back to the Deep Dive.
Great to be here.
Today we're jumping into IAS 37. That's provisions, contingent liabilities, and contingent assets.
Right. Sounds a bit formal, but it's actually super important stuff. It dictates how companies report things that aren't quite certain yet.
Exactly. Think potential future costs, or maybe even future gains. This standard's been around since '98, with updates, of course.
And our mission for you, the learner, is to sort of cut through the jargon.
Yeah, let's nail down these core ideas, provisions, contingent liabilities, assets, so you can get a clearer view of a company's real financial situation.
Okay, let's start with the basics. Definitions. What is a provision?
Good starting point.
Well, fundamentally, it's a liability.
Okay, an obligation.
A present obligation, specifically, stemming from something that already happened, a past event, and it's expected to lead to an outflow, cash leaving the company.
But the catch is the timing or the amount is uncertain.
Precisely. That's the core of a provision. Liability, yes, but with some question marks on the when or how much.
You mentioned a past event leading to a present obligation. What makes an event? Well, obligating.
The obligating event. That's the trigger. It's that past action or event that creates either a legal duty.
Like a contract or a law.
Exactly. Or, and this is quite interesting, a constructive obligation.
Constructive? What does that mean?
It means the company, through its own actions, has created a valid expectation that it will accept certain responsibilities.
So like a long-standing policy they've always honored. Or a public statement.
Yeah, exactly. Past practice, published policies, a specific statement. If it makes others reasonably expect the company to follow through, that can create the obligation, even without a specific law or contract. The key is there's no realistic alternative for the company but to settle it.
Okay, that makes sense. It's about expectations they've created. Now, what about contingent liabilities and assets? They sound iffy.
They are. The word contingent gives it away, doesn't it?
Yeah.
A contingent liability is a possible obligation from a past event.
Possible, not present.
Right. Its existence will only be confirmed if some uncertain future event happens or doesn't happen. And, crucially, that event isn't fully within the company's control.
Okay. Or is there another type?
Yes. Or it could be a present obligation, but it fails the recognition test. Maybe the outflow of cash isn't probable, or you just can't measure the amount reliably.
Got it. So, possible obligation, or present one that doesn't quite make the cut for recognition, and contingent assets.
Pretty much the mirror image. A possible asset from past events, dependent on uncertain future events outside the company's control.
Possible asset, possible liability. So recognition.
Yeah.
How does that work? When do these actually hit the financial statements?
Big difference here. Provisions get recognized as liabilities on the balance sheet, but only if 3 specific criteria are met.
Okay, what are they?
1, present obligation from a past event. We covered that. 2, it's probable, meaning more likely than not, that an outflow of economic benefits will be required to settle it.
Probable. That's a key threshold.
Absolutely.
Yeah.
And 3, you can make a reliable estimate of the amount of the obligation.
All 3 have to be met.
All 3. If even 1 isn't met, no provision is recognized.
So what happens to the contingent ones then?
Contingent liabilities are not recognized, but they are disclosed in the notes to the financial statements unless the possibility of an outflow is really remote.
Disclosed, not recognized.
Okay.
And contingent assets.
Same logic, really. Not recognized. Never recognized, actually, because recognizing them might mean recognizing income that may never materialize, but they are disclosed if the inflow of economic benefits is probable.
Interesting asymmetry there. Contingent assets only disclosed if probable, liabilities disclosed unless remote.
Prudence,
Right.
Don't count your chickens, but definitely warn about potential wolves.
Right. Okay, so let's say we meet the criteria for a provision. How do companies figure out the amount? Measurement.
It has to be the best estimate of the expenditure needed to settle that present obligation at the reporting date.
Best estimate. Sounds a bit subjective.
It involves judgment? Yes. Management uses their experience, maybe gets reports from experts. Think about what the company would rationally pay to settle it right now or transfer it to someone else.
What about situations with lots of similar items, like product warranties?
Good question. For large populations, they often use an expected value calculation.
Expected value.
Yeah, you weigh all possible outcomes by their probability. Say 10,000 products sold, maybe 20% chance of minor repairs costing, say, $1 million total. and a 5% chance of major repairs costing $4 million.
Okay.
The expected value would be 20% of $1 plus 5% of 4 meters. That's $200,000 plus $200,000, so $400,000. That would be the provision.
So a probability-weighted average. Makes sense. Do risks and uncertainties play a role?
They do. They have to be considered in the best estimate.
Yeah.
But the standard warns against creating excessive provisions or deliberately overstating liabilities.
There's no padding the numbers.
Right. And if the settlement is like way off in the future and the effective time is material.
Oh, you discount it.
Exactly. Discount it back to its present value using an appropriate pre-tax discount rate.
Got it. What about things like future technology changes or new laws? Do they factor in?
Only if there's sufficient objective evidence they will happen. Like, say, new legislation is virtually certain to be enacted. Then you'd factor that in. But not just wishful thinking about future tech making cleanup cheaper, for example.
Makes sense. Stick to the objective evidence. And one more thing on measurement gains from selling assets.
Nope. Don't factor those in. If you expect to sell an asset as part of settling the obligation, you account for that gain separately, not as a reduction of the provision itself.
Okay. Let's touch on onerous contracts. There was an update in 2020.
Yeah, clarification, really. An onerous contract is one where basically the unavoidable costs of meeting the obligations exceed the economic benefits you expect to get from it. It's a loss-making contract.
Okay, so if you're stuck in one,
Then the present obligation under that contract is recognized and measured as a provision.
and the unavoidable costs are.
It's the lower the cost of actually fulfilling the contract versus any compensation or penalties you'd have to pay for failing to fulfill it, whichever costs less.
And the 2020 update clarified what's in those fulfillment costs.
Exactly. It confirmed that the cost of fulfilling includes not just the direct incremental costs like materials and labor, but also an allocation of other costs that relate directly to fulfilling that contract.
Like depreciation on a machine used specifically for that contract.
Precisely. Costs directly related to the contract activities.
Good clarification. Finally, restructuring. Big changes in a business. When does that trigger a provision?
Only when the general rules for provisions are met. Present obligation, probable outflow, reliable estimate, and there's a constructive obligation to actually restructure.
Constructive obligation again. What does that mean for restructuring?
It means two things need to happen. One, management has a detailed, formal plan for the restructuring. Identifies the business, locations, employees affected, costs, timeline, etc.
Just having a plan isn't enough, though, is it?
No. The second crucial part is that the company has raised a valid expectation in those affected that it will carry out the restructuring
How?
by either starting to implement the plan or announcing its main features to those affected in a sufficiently specific way. Just a board decision isn't enough.
You need that public commitment or action.
Right. And the provision itself should only include the direct expenditures arising from the restructuring, like employee termination benefits, costs to close a facility, things necessarily caused by the restructuring.
Not things related to the ongoing business, like retraining remaining staff or marketing.
Exactly. Those are ongoing activities, not part of the restructuring provision itself.
Okay, let's try and wrap this up. Key takeaways.
I think the main thing is the distinction. Provisions are liabilities on the books, recognized because they meet strict criteria, present obligation, probable outflow, reliable estimate.
Well, contingent liabilities and assets are just possibilities, right? Disclosed generally, but not recognized.
Exactly. That probable threshold is really the gatekeeper for recognition.
And these aren't static. Companies need to reassess them constantly.
Absolutely. Circumstances change, estimates improve, possibilities become probable, or vice versa. It's dynamic.
So for you, the learner, digging into IAS 37 like this gives you that deeper insight. You can see potential drains or gains that aren't maybe obvious just from the headline numbers.
Yeah.
It reveals more about the real commitments and risks a company faces.
Definitely gives a fuller picture.
And a final thought to leave you with. How might understanding these principles about provisions and contingencies affect how you interpret other areas of financial reporting? Where else might these underlying ideas of probability and obligation pop up? Something to think about.
Good question.
Thanks for joining us for this deep dive. Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.